This is the second lesson of this financial modeling course, and what we're doing in this lesson is we are using the assumptions from the previous lesson to then forecast our asset cash flow. So we are not yet including any sales proceeds, and we're also not including any acquisition costs. So all we're doing for now is we're forecasting the operational cash flows of the asset. And we will then later use the operational cash flows, so the asset cash flows, for our unlevered cash flows and our unlevered returns. But for now, all we're doing is we're focusing on the asset cash flows. Okay, so this is our second lesson of our basic baby back of the envelope financial model. So just a reminder, in this model, we're modeling the cash flows of an asset on a single or with a single lease to one tenant. So, and we want to keep it really simple. And therefore, all we're doing is we're modeling annual cash flows, and we're modeling out those cash flows for 10 years. So we keep it really simple. And in the last lesson, all we did is we put in the assumptions on one tab. So we added one tab, we put in all the assumptions on one tab, and now we're using those assumptions to model out our cash flows. And the first thing we do is we model out our asset cash flows. And our asset cash flows are essentially the cash flows that the asset is producing, but we're not yet taking into account the effect from buying the asset, so how much we're paying for the asset. And we're also not yet taking into account the value of the asset when we sell the asset. So it's literally just the cash flows that the asset produces. Okay, and so that's what we're doing here. So the first thing we're doing up here to the top, we are adding a couple of rows, and we can add rows in financial models, so in any Excel spreadsheet, by entering Alt-IR. So Alt-IR, repeat the action. And now we are adding what I call toggles. So the toggle is are the years essentially, which we use afterwards to essentially determine to have a more flexible cash flow profile. So it allows us to change the exit year, for example. Let's move them to the right. So we have 10 years of cash flows. There you go. Actually, we have 11 years, so we can delete this. Okay, and now let's include our asset cash flows, which we add here to the bottom. So the first thing we do is we add the dates. And we link this up directly to the assumption. So when we change the dates, our cash flows, or when we change the assumptions, our cash flows also update. And then we forecast our dates via the EU months formula, right? And it's an annual cash flow sheet, so we're adding 12 here. So this is the formula. EU months, so we take the previous date and we add 12 months on the top of it. So that means the next column is 12 months after the first column. If we wanted to model a quarterly cash flow sheet, we would just simply include 3 months here, right? So if we had a 3 here, it would be quarterly cash flow model. If we had a 1, it would be monthly cash flow model. But because we're having an annual cash flow model, we're adding 12. Now we format this correctly. There you go. Okay, and it's December 24, right? So December 23, 24. And now all we're doing is we're dragging this out to the right. Okay, for 10 years. Okay. And so that makes sense, right? So we start with December 23, we have 10 years of cash flows, so we end in December 33. Great. And now the first thing I want to do is I want to project our rents on a per square meter basis. Okay. And let's let's make this a little bit wider. And we link this up to the rents per square meter per month here. Okay, and let's put a euro sign there and 1 decimal. And now we're growing our rents by 3% per annum. Okay, and I need to make a small disclaimer here. because the way you typically forecast or model your rents is by growing your in-place leases at the rate of inflation, because very often your leases are inflation indexed, so your rents grow by the rate of inflation. In this case, we're growing our rents by a fixed rate, and this could happen, for example, when you have fixed rental uplifts in your lease agreement. So usually your leases are indexed to inflation, but it doesn't have to be this way. So let's just say, for the sake of this case study, we are growing our rents by a fixed rental uplift of 3%, and the rental growth is independent of inflation. Often that is not the case. Often you would just grow your rents at the rate of inflation, which in this case would be 4%. But here, for the sake of this case study, we're assuming fixed rental uplifts every year for 3%. Okay, so we're growing our rents by 3%, we're locking the rental growth, and we drag this to the right and we click Control R. Okay, so now we copy this over to the left, we copied this over to the right, and we're growing our rents every year by 3%. So our rents in year 10 have grown to 40 euros per month on a per square meter basis. Okay. And we can model it like this because we also have a 10-year long lease. It would become significantly more complicated if we only had a short-term lease of like 3 or 4 years, because then we would have to see what would happen when the lease expires. And so that makes things much more complicated from a financial modeling perspective. And we will see how to do this in the more advanced financial modeling courses. But for now, we keep it really simple, and we're modeling simply one single long-term lease. So we don't have to worry about what happens at lease expiry. And the next thing we're doing is we're modeling our occupancy. And because it's a single tenant and the building is fully occupied, the building is 100% let. Okay, so we link this up, and now we keep this flat. It's 100% throughout the 10 years. Okay, now the next thing is, now we can calculate our total rents per annum. How do we do this? Well, it's very simple, right? Because all we're doing is we're multiplying the rents by 12, because we analyze our rents, and then we divide this by 1000, because we express our numbers in thousands. But then we have to multiply this number also by the total surface area, and then by the occupancy. Okay, and then of course we have to log, and we copy this over. There you go. Okay, so now we have our total rental income for the next 10 years. Done. So that's our total rents per annum. And the next thing we're doing now is we're including our OPEX costs. And we do know that we have OPEX costs of 250,000 euros per annum. How do we grow? And it's a cash outflow, so we have to pay for it, so it's a negative number. Okay, and now we grow our OPEX costs at the rate of inflation, which we assume for now is a fixed rate of 4%. You could be more precise and model, your inflation rate on an annual basis and then have a different inflation rate for each year. But again, we want to keep it relatively simple. There you go. And now you have your OPEX costs for the next 10 years, which therefore means that we can now calculate something that is called NOI, which stands for net operating income. And so net operating income is a very important number for financial modeling purposes, because in the end, we will value our assets on the basis of our net operating income. So we capitalize our cash flows, we capitalize our NOI, and derive our exit valuation on the basis of our NOI. And the NOI is literally just the rents less the OPEX costs. Okay, let's put a line here. Okay, and because it's essentially a subtotal, I want to add a currency here, and I shade this in gray just so that it stands out a little bit. And after NOI, we have something that we call AM fees, which stands for asset management fees, which in this case study is 6% of the rental income. So we have to pay some property manager to manage this asset. We have to pay him some money. And the AM fees are based on total rents. And it's a cash outflow. So it's 216,000 in year one, and it obviously grows at the rate by which the rental growth also grows. So it's linked to rental growth. And therefore our AM fees also increase every year. We made a mistake here. What did we do wrong? Well, we locked the wrong cell again. We should have locked H21, and we copy this over. And there you go. And now we can calculate finally our asset cash flows, which are the net operating income less the AM fees. And that's basically it. Okay. So we add them up because we're subtracting a negative by adding the negative. So we're adding up those numbers, so the NOI and the AM fee. And I want to remove those little green triangles. Just as before, I want to make sure that the asset cash flows stand out a little bit. So I changed the color to gray, put a currency symbol here, and I also have a little border on the top, and I also changed the color of the dates a little bit. And I want to put a border here too. Okay, perfect. And so now what we have done is we have modeled our annual asset cash flows, which are based on the assumptions on the top of this worksheet, which we completed in the previous lesson. And those asset cash flows are now the cash flows, or represent the cash flows that the asset is producing before the sales proceeds and also before the purchase price. And it also yet doesn't include the impact of debt financing. So those are literally just the cash flows that the asset is producing. Okay, and so this is the second lesson. So done, we've completed this lesson.